G'day everyone, welcome to another weekly general update for the 22nd of July. And in the last week there's not been a great deal that's changed, although maybe the situation is clarifying just a little bit in terms of whether the US market has reached a top or not. So we'll have a look at some of the key charts around that. First, just a reminder on the general advice nature of this information. We obviously don't know anything about your personal circumstances. So a bit of a summary of what happened last week. The S&P ended up gaining 6 points, but it was down, and then it was up, and then it lost some more ground on Friday night with another reversal. So I'm still posing the same question that we did last week. Is this counter trend rally complete? My view is the primary direction is down. We've had one lot of 5 waves down. We're in the process of completing 3 waves up. And then I would expect to see weakness fairly soon throughout August and possibly into September. 1267, 1207, still the objectives until we see the market show its hand a little bit more. And the earnings seasons in the States has been giving some mixed results. Some of the banks have done pretty poorly. Some of the tech stocks have done poorly. Some have done very well. Microsoft had its first loss, I think, ever. So there's been a real mixture of results, and I think I've said this before, that the US corporate earnings are basically top of the cycle at this stage. Margins are about as healthy as they've ever been, so they may be able to sustain them, but they're certainly not going to be able to improve them, I wouldn't think. Now, the Australian index ended up gaining 117 points on the week, but it will obviously give some of that back on Monday. I would expect to probably give back maybe 40 points on Monday, and so that was the positive for the week, and that has taken our index now to the top of a bit of a broadening range, which is capped at about 4,200 at the moment. And with the banks looking fully valued, with Telstra looking fully valued, and obviously resources under a bit of pressure, it's pretty hard to see our index going much higher than where it is now. There's lots of stocks going sideways, there's many stocks going down, and I would expect we're going to see profit warnings as we go into the reporting season. Now, the US dollar index is obviously the key. We'll look at that chart first. It traded back into the range, but reversed back up again strongly on Friday night. So that could be an indication. If that continues to the upside, then I think we certainly have seen the peak in the stock market. And when we look at the euro US dollar, it's really in quite a strong downtrend and targeting 118. Now, bond yields also a real worry. The Spanish 10-year bond yields moved sharply higher, I think nearly 3% higher, to 7.27. So that really is very bad territory for Spanish government bond yields. The Italian yields also went up a little bit, not as much percentage-wise, but they're back up above 6% as well, so not particularly good there. So let's have a look at some charts, and we'll start with the US dollar index. Let me just remove this little framework first. So you can see we've been in this range here between 81.5 and 83.5. We had a very minor break for a couple of days. They're key levels, and if they break, we're looking at 86.7 and possibly even closer to 89. Now, you can see here that the market pulled back for 4 or 5 sessions on decreasing range and decreasing momentum. And if we have a look at where that actually went to, it came back on a closing basis to exactly the 38.2% level and then turn around. Now, the fact that it's only come back to 38.2, if this follows through to the upside, is a sign of strength. So I think the odds have now shifted again that this will probably break this resistance and head higher. So a close above 84 would certainly confirm that, and if that is the case, then there's no way that stocks are heading higher from here. So you need to watch the US dollar index very closely, but that again has shifted the odds back towards the US dollar rising and stocks going down. This is the Euro US dollar. You can see we're in a very clear downtrend, and we've got some support down here at around the 118 mark. We're sitting at the moment 122. So still a bit of downside there yet, and it's possible, of course, that the euro could break that level. And looking at those Spanish bond yields, it's not particularly good in America. Let's have a look at the S&P. So we've had, if you have a look here, we've had quite a strong run up to the peak in June. We're clearly in a channel, a rising channel, but you'll notice that the second last peak on the 3rd of July did not reach the top of the channel. And if this is the peak that we had just 2 sessions ago on Thursday, then it's finished even further away from the top of the channel, and then quite a sharp move to the downside. Now the ultimate test of this will be if we get a close below, definite close below this lower boundary of this trend channel. So somewhere around about 1345. Anything that starts closing definitely below 1345, then I think we can assume that the peak is in and we're into a 5-wave decline which could last several months. But as I said earlier, it will be driven very much by the euro and the US dollar direction. Let's have a look at the Australian market. Here's this broadening triangle. We've got basically a horizontal base and a slightly inclined upper boundary. We had a strong day on Thursday, indecisive day on Friday, and I would expect that we'll get a move back down, perhaps 40-50 points on Monday, and so it could well be that we're heading back down again now in that particular index. Let's have a look at finance. You can see finance index in Australia has been very strong, but we have got up to a double top now, and that's not a bad reversal pattern, so I wouldn't be surprised to see some downside in the finance index. And you can see from the RSI we're also quite overbought, so certainly due for a pullback. And if we look at materials, you can see it's really been going the other way, a bit of a downward bias if anything, and really struggling. Okay, so let's have a look. Just going back to that previous point, with these bond yields with Spain and Italy, if the situation in Europe deteriorates, there is going to be an impact on the Australian banks, because as solid and secure as they are, they still get something like 40% of their funding from the European market. And if these yield trends continue in Europe, that's going to put pressure on the Australian banks' ability to raise funds out of Europe, and that is going to have an impact here. At least the potential issues, I think, will start weighing on the share prices. So we may well have seen the peak in the banks in Australia. Now looking at gold, ended up losing $7 on the week. It was a pretty quiet week, and it's still just stuck in this range between 1550 and 1650. It's been in there now for something like 10 weeks, as we'll see on the chart. And the HUI index in the States was largely unchanged for the week, so gold stock's not really doing very much at all in keeping with gold. Now copper lost ground on Friday night, but has spent most of the week close to $3.50. And despite all the negative signs around, I still look at copper at $3.50, and you've got to think that globally, from a resource point of view, things can't be too bad if copper is up at that level, because that's still a very buoyant and very profitable level. Now oil has been rocketing up of late, shot up to $92 during the latter half of last week. I think that's largely due to events in the Middle East rather than necessarily being demand driven, although certainly the noises that China's been made about further stimulating their economy wouldn't be bad for oil either. There's the 6-month chart for copper. So look, we're off the highs, up close to $4, but as I said, $3.50, $3.40, still very, very profitable territory. Now, looking at things overall, the most likely scenario, I believe, is that we've topped out or we're close to it. There is a Fed meeting on the 30th and 31st of this month. I will be surprised if Bernanke moves at this stage with QE3. I think we're too far out from the US election. So I think the way this may play out is that they will say no to QE3 but leave the door open, as they did about a week ago. That'll probably disappoint the market, particularly if matters in Europe deteriorate, if we get some other poorer earnings results out of the US. And Europe will then become the focus again, I believe. And that will probably lead us, I think, fairly nicely into to the 5-wave decline that I've been expecting. So in terms of your current exposure, I would be looking at having minimal exposure to the long side, unless, of course, you're talking medium to longer term investments. I do expect that we'll see a stronger rally into the end of the year, but who knows how sharp this upcoming dip will be if that's in fact how it plays out. But certainly all the signs are heading that way. Some weakness during August and September, and then some real strength into the end of the year. So I think if we do get a decline, and I hope we do because it'll set up some great buying opportunities. There's already a lot of resource stocks that are very, very cheap. And if we get yet another leg down, it'll set up some great buys in future months. So that's how things are setting up at the moment. It's really just week by week, and we'll talk to you again next weekend. Cheers.